Okay, we are now live. We'll give it a few seconds and then we'll jump into this. Today, we're going to be talking with one of the co-founders from Carrot DeFi, James. He'll be joining us in just a second. He's going to talk you through what is this dApp that he and his co-founder have created and why should we be using it. So settle in. Remember, we'll take any questions as well, so you can post them and we'll take them at the end. But I think the live stream should have started. So let's welcome James, who goes by JSP on Twitter, to the stage. How are you? Hey.
I'm great, man. Real good.
Awesome.
I mean, honestly, the fact that we had a launch this week and I've gotten sleep is like a huge testament to how well things are going, I have to say.
Definitely. So just a quick little bit of background. Who are you? And then tell us about DeFi Carrot DeFi.
Yeah. JSB, I've been in the space, man, really actually the DeGen8s brought me to Solana. I had dabbled in, Ethereum and Bitcoin back in like 2012, back in the day. Yes, I sold all those tokens, did not hold those to now. Thank you very much, like most people. But really DeGen8's like kind of piqued my interest to get interested in Solana. Before that, I ran a digital strategy agency for about a decade. And was bored. And Solana was like this new frontier, and decided to fully red pill myself and say, hey, I need to grow and evolve and learn or die. And so Solana became kind of like a second home for a while, and was in the communities, NFT craze, had a lot of fun, built a lot of fun utilities, and just kind of learning by doing. And I went full time into kind of Web3 exclusively on Solana 2 years ago when I joined B&J Studios to build the Raindrops Boots product, which was a lot of fun, a lot of learning in doing that. And it's actually where I met my co-founder, Jack. Jack is the CTO, and he and I, largely built a lot of that infrastructure and platform and front end and branding and stuff. Yeah, at the end of last year, towards the end of last year, he and I had decided that, hey, we were going to go start a new venture on our own and figure out, hey, what are the things that need to be built? And that's kind of like when Carrot started. And we can get into like some of that origin story as well, but this is just a little background. Both of us are technical, which I think is a huge advantage for anybody who's founding a company in this space, to have two technical founders who can really, I'd say, like, we yin and yang really well. Jack truly is like a phenomenal back end engineer, and I do a lot more of the front end user experience stuff. But yeah, we work really, really, really well together to build out kind of both sides of that equation.
Great. Well, I'll put your screen up, and then maybe you can tell us, or show us the Twitter. So anyone that's new, you can follow Twitter. It's very, very new. And then just talk us through what is Carrot.
Yeah, I'll pull that Twitter up.
Let's see if it.
This tab instead. That pop up?
Yeah. So you're new. So you're new. You've got plenty of followers already. You've been building, I would say, in stealth. Like, a few people. You did like a small. Sorry.
There's your mug right there. There you go.
Yeah.
Love for sale.
Face, it needs a little bit of a weight loss.
I'd say we built really fast. So kind of our MO and what we were particularly good at was like protocol building. And so once we landed on the idea, we say we started at the beginning of the year. I said we really started in earnest on this particular idea in March, and had a working prototype in mainnet by April. And so technically the system that we're running has been live and running on mainnet for a couple months now, and has given us the opportunity to like continue to work and tweak and figure out what works and what doesn't work. And we raised a small round of funding in April to kind of help us do this kind of go to market. And any founder would tell you, you got to find out really quickly, like, do people care? We think the idea is cool. We think it's really solid. It's really simple and straightforward. We think it solves our problems. Like, it's a product that we want to use, which we think is also pretty key when deciding what to build. And so we love it. I'll continue to use it if no one else cares. But in terms of it being a venture and a startup that is worth anything, we need to know if other people care, kind of feel the same way that we do about it. And so, yeah, got to work building. We'll call it stealth for sure. The space is full of noise and full of just everything is popping off anywhere where everyone's depressed. And so you got to start kind of claiming your space and kind of getting your name out there. We work with an awesome team. The Skyrise Studios guys has been awesome partner for us as kind of our marketing arm.
I don't know who those guys are. They look after your marketing.
Yeah, they look after our marketing. Chico is a longtime friend in the space. A lot of people probably know Chico. If you don't, you should. But they've been really great, kind of helping us be on board with the messaging and kind of getting the word out there and connecting with a lot of communities and stuff like that.
Cool. So let's not. What is Carrot?
What is Carrot? Yeah, what is Carrot? So Carrot is a yield-bearing token. And you might be familiar with other forms of yield-bearing token. We don't hear that term necessarily a lot, but it's very similar to, some people call it like an LST or liquid staking token for stablecoins. It operates fairly similar to a coin that I think is most people's favorite coin on Solana, JLP, which has kind of been an up-only token for forever and really solid from the Jitter team. So it operates a lot like that. And depending on who you are as a DeFi user, if you ever experienced DeFi before, it kind of solves different tiers of problems. And so let me start with kind of the base, maybe a new user to the space. DeFi, even for like power users, can be like super confusing. There's so many options, so many pools, everything, because of the decentralized nature of what we do, everything tends to skew towards a menu of options of kind of select your own journey, customize it for yourself, do it your way, have full control over everything. Like, we're just a protocol. You make the stuff on our protocol and we'll extract a fee if you use it. And just my product background experience really told me, people want more direction. They kind of want less options. They kind of want to know that there's somebody who's smart, managing the risk in the product for them, continually making it better, and just kind of want to know that it's simple and straightforward. This is what it is. I like it. I can buy it. And all I have to do is hold it. And when you think about it, in our space, like the only thing, like the main first primitive you have to learn about is buying and holding a token, right? That is the basis of what we do here, and especially in Solana. And for us to reduce down this service of this tokenized yield aggregation service that we perform into a single token form, we felt was kind of this gateway and path for people to experience and enjoy the benefits of DeFi in the absolute simplest way possible. It's the most straightforward. Hey, if you've bought a meme coin, you got to Solana because you saw WIF pop off, or you're a bonk fan like me. If you've bought a meme coin, you can buy this token. And if that's all you know about Solana, then you understand and can participate with our DeFi ecosystem, which we think is a really powerful primitive at the most basic level. So for anyone kind of wondering what that means, you give us your stable coins, it mints you more tokens. So it's an unlimited supply. And the way that works is there's what we call like a share, think of it as like a share price, or we call it a NAV price, net asset value, which is the number of assets that are in the pool and the number of tokens that are minted out there, the supply of the tokens, and that establishes like a ratio. You can think of it that way. Our starting ratio was around $100, and it doesn't matter if you're putting in $100 or $1 or $1 million. There's no slippage in between that because it's all happening at that ratio, and so it allows people to deposit what they want and get back this token, and then you just have to hold the token. And instead of like your bank account, where when you accrue interest over time, you're getting more units of US dollars in your account, which comes in as income. In our case, the value of the token goes up over time. So this is where that comparison to a liquid staking token comes in. So native staking, it's staked, you're getting units of SOL over time from block rewards, and that account is growing. Whereas in LST, you have the same amount of the LST over time, but the value of it is getting larger because the pool that it represents is growing from that income that's coming into that account. And with that primitive, we'll get into like the power of that and why we're different and what that means. But for the more power users of DeFi, one of the problems we solved that we really felt was, hey, stablecoin lending, like USDC lending is king on Solana. And it's where the best rates are. It's where the most like real yield activity is. It's not juiced up by rewards or like third-party tokens or kind of these incentives where you see these crazy 400%, 120% APYs. It's really solid. It's really steady. It comes from the borrow side. So like we know where the yield comes from. It's like a good real source of yield. But if you choose a single protocol to do that lending, so a Camino or a Marketify, a Mango, Drift, like when you choose a single place to do that, like that's a good first step, but you quickly discover a few painful UX points, at least from my perspective. The first was the money leaves your wallet. The wallet serves as like the homepage for anybody in crypto these days. You know, when I check my balance, I open up my first step is I'm opening up my wallet. And when you lend out your tokens to these protocols, they obviously, for good reason, like they leave your wallet because they have to be lent out. Someone has to borrow them. You can't keep them if they're being borrowed, right? And so it's harder for you to track the performance without connecting to their DApp or using kind of portfolio aggregator, you know, to check in on your investments. It's hard to like keep tabs on that. And keeping tabs is actually pretty important in our space because rates fluctuate wildly. And the reason for it is rates are set programmatically. This is the decentralized nature of borrow lend, which is great. But oftentimes you'll see these rate spikes and say, oh, it's 30% over here and you're getting 8%. You're like, what the heck? And so you go quickly log in, you withdraw your money, which costs you a transaction fee. You then go deposit it in the other spot. It's take you probably, if you're super quick, 3 minutes to do. Well, in that 3 minutes, that rate could have dropped. Like that rate now could no longer be on par. And because you moved the money, you're no longer earning interest in between it. You're touching that account, so it's not optimized. And it becomes this problem of this cat and mouse feeling of, I hate the idea that I could be getting a better rate somewhere else, and there's very little barrier for me to like move that. And so you start playing that game until you realize that you end up being the big loser. It is worse for you to like manually do that. And so this is like that pain point. We said, hey, like we can solve that programmatically. We can interface with these protocols at a CPI level and move that money.
What does it mean by CPI?
I think that kind of like we are talking our program is talking directly to their program. And so our on-chain program is able to like send those transactions and move that money from the vault to those protocols in a single bundled transaction rather than the withdraw and then move. We can kind of bundle it in one, which makes it really capital efficient as well. And just this idea, and we've seen like this product is like one of the OG DeFi protocols that really took off on Ethereum is Yearn. You know, this is like tokenized Yearn for anyone who's been around and kind of knows what Yearn is. And it really helps solve a lot of those pain points of, I could wake up every day, look and see who has the best rate and move my money there to like get the best rate. On Ethereum land, that like wasn't really feasible because it just costs a lot to transact. Whereas on Solana, we can be reactive to rates and move a lot of money very quickly to respond to those rate changes because it's fast and cheap and it's great. It works really, really well for those use cases. And so all those pain points, and there's a few more we can get into if we want to get into the nitty gritty, kind of combined to this one idea of like make DeFi really simple and straightforward. All you have to do is buy and hold a token. It is designed tokenomically to just go up over time because it's fully collateralized. It's backed by all the stable coins that are in the pool. And those stable coins are always earning at an optimal yield rate. We call it a risk managed rate because we're not moving funds 100% around. And the risk management is another key point we can get into. But that is the genesis and the idea behind Carrot of, hey, I want a token I can hold in my wallet that stays there, that I can track the value straight from anywhere, and is letting me have a peace of mind knowing that like they're always working to get me the best rate over time.
Yeah, no, that's good. And so what with the Carrot token, obviously that's going to go up with appreciation of the USDC that's been lent out. Where can we see the current APY on the return?
Yeah, so we're working on like how do we like show those metrics in an appropriate way. But like on our app, if you log in, go to use.deficarrot.com. You can use the code xmonty to get in if you don't already have one. This is like the easiest way you can interface and buy Carrot. So you type in, hey, I have $100 of USDC. I want to buy CRT. Got a little Carrot, so I can take my money over here.
Very cool branding. I think this is some of the coolest branding I've seen.
Thank you. Looks like my wallet auto-logged me out because that is good safety protocol here.
That's what Backpack does.
That's right.
Unfortunately, well, I don't like it, but if you like it, great.
Actually, you can't even see
I can't see your
this.
wallet, so that's fine. There's no.
That's fine. You don't need to see that.
Oh yeah, I'm just letting you
But
know that you're secure. You're secure.
and I approve it. Success. Great. If I come here and I share this tab, I just bought Carrot. Great, I've got it. And all I have to do is like hold that token in my wallet, and I can come back here and I can come redeem that Carrot. And I'm going to get that USDC back, which you can't see because I need to share this one instead. So what's really important though is there's a few factors. So one is we expect that over time you can just track the token price, and kind of see like the slope of that line over time really represents the yield of like the growth of that asset. So it should be in line with kind of the yield that we are accruing. But you can always come here and we publish these metrics. We want to be like really transparent and just say, hey, like we're not making this yield up. Like we are pulling it from these other sources. Here's where it's coming from. Here's the rate that we're seeing. So you see this is the token price right now as we calculate it, the TVL, and then down here we kind of show the breakdown of hey, where is all the money? And you can see that we have 2.12 million right now, and 1.5 of it is Camino JLP, Camino Alt. And this is one of those things of saying we take an opinionated view of this, where in a lot of other DeFi protocols that do similar stuff, they might add support for a new pool. Like there's, if you don't know, so Camino for their USDC pools, they have a couple of them. They have the main pool, which is paired with
Did you want to pull it
tokens.
up on your screen quickly?
Yeah, let's go look at
not as
Camino.
Just so it's visually.
Yeah, absolutely.
Known. I mean, I know it very well, and a lot of people would, but hopefully we have some new viewers here as well.
Where
so you've got these different segregated markets.
Okay, right. So you've got this USDC JLP market. You've got the main market, which is paired with the rest of the tokens in the main market. You have this altcoin market. You have this new Athena market. And each one of these pools is like a permissionless, like, oh, here's the pool. Go use it if you want to. And that's how like most DeFi protocols that are doing similar stuff is going to work. They say, hey, we've now made this available to you, but it is on you to go like opt in to that. And there's a lot of like reasons for that. It's not a bad strategy. A lot of people really like that control. Say, oh, I don't want it in Drift, or I don't want it in Margin 5 for whatever reason. Like, give me the best rate between these three. But for us, we're taking this opinionated view of you are trusting us to manage this for you. And like in our system from the very beginning, we've always had the Camino JLP pool and the Camino Alt market pool in there, and the main market pool. Because those rates are different and they fluctuate, and like sometimes it's the best one over here. And for instance, like the question we get a lot is like, hey, when are you gonna add PYUSD? Like those are the best rates right now. And like we are adding that probably next week, coming up really soon, because we can do that. Like we know how that works. Like there are other reasons, like the way that the rewards are paid out is kind of like where that delay comes from, and it's not always like continual, and you have to like pull it from the reward balance. So it operates maybe a little differently than like the real yield of these other pools. But once we do that, every token holder benefits from us doing it, not just if you go and opt in to it. So it is a different approach, but it's one that we feel people enjoy, knowing that somebody is continually monitoring and plugged into the ecosystem and working hard for them to make sure that they're getting the best risk adjusted rate that they can get.
Gotcha. So we'll take a couple of questions, and maybe I can answer and you can answer as well. But this one question is like NX Finance is 10 to 11% as well for lending. Of course, that can fluctuate. And what would it take for you to add another vault? Like it needs to be like have open source technology, or like obviously, or thoroughly audited.
Yeah, so we have kind of a risk matrix that we run any protocol or any like potential integration partner in to kind of figure out, hey, like, do we trust them? What kind of guardrails should we put on them? The 5 that we're integrated with right now all get about the same score. So we treat them pretty equally between, Mango, Margin 5, Drift, Camino. And if we were to add a new one, there are factors like, hey, have they been audited multiple times? Have they gone through exploits or risk before? Are they open source? How much volume have they pushed through? Like, how new is this? Are we the guinea pig? Or are they, in a solid foundation, in a solid point? Are there insurance funds? And all those factors kind of lead us to how, when we figure out allocation proportions to send, the money, this breakdown you can see, here on this chart. If there were another yield source that we integrated into that, let's say, was new or like was pretty small, we'd put more guardrails on it, monitoring wise, and say, hey, we're never gonna like be more than 20% of a pool, or some things like that, where like we don't want to represent such a large position. The other key part of this risk management, we think is kind of an underrated aspect of people when they use DeFi. We kind of know like, oh, like there are risks, super risky, but do you really know like what they are? Do you know how to protect yourself against them? And for us, we say risk management is really key. So we're never moving funds 100% in any direction into any pool. One, because there's rate compression. So because the rate's programmatically set by the amount of borrow and supply, something called C ratio. If rates are super high, they're high to attract people to bring money. Like they want it to like come down. Like that is the point.
But if you go and move $2 million, then you bring down the rate.
We'll crash the rate. In fact, we'll make it like worse than it was before. And so we have to like do that really intelligently and how we kind of move that money. But we also like don't want to be super concentrated in one spot, because if there is an exploit and all the money's there, it would all be gone. And so we do take that risk managed approach between all of them. But it's also because we are continually like monitoring all these protocols. And if there were something to be going on, we're going to be in a better position to respond and react and move that money out and keep it safe for you than you ever are going to like see it on crypto Twitter, log in, get your wallet out, try to withdraw your money. Like we're already like 50 steps ahead of you and like are already taking those steps. And so there's this level of security and comfort. And though we can't like state 100% guarantee or anything like that, we know that we are in a better position because we're in a 24/7 monitoring situation to respond to these things, to kind of keep your funds safe, which is really what you want. Like you want a risk managed rate. You don't want the highest risk rate for stuff like stablecoin.
You're better than we are, right?
Yeah.
So
exactly.
this next question is, how actively is this managed? So like, let's say tomorrow there's an exploit at 1 a.m. on Camino's JLP USDC vault.
Yeah.
How long does it take to respond to that kind of thing?
Yeah, so there's a variety of ways that we like think about how we respond, and like how we can respond, and it's a system, frankly, said that like we're only gonna like get better at over time. But there's certain things that markers we've like done, looked at historical events of, hey, when USDC depegged or when there was the Mango exploit, and one or two other events, and said, hey, what conditions became apparent in the data that like represented that going on, and how do we then say, hey, when these things like this sets off alarm bells, and like we pull money out as a result of that. So if we were dead asleep or unavailable, not watching, the way the architecture works, and I will
share your screen.
Yeah.
Sure. Yeah, because look, I mean, these are very helpful because it can, I'm getting better at elevator pitches,
Yeah.
Which is just why use Carrot, and it's taken a long time to go through where I can see all the value proposition of Carrot, and I'll be able to sum it up at the end, hopefully in a pretty good way. You may even take it, but let's add this to the stage and go through this. But yeah, I can start to see that this makes a lot of logical sense. You may have a slightly smaller yield, but you've got far more exposure to different things in case something does go wrong, which is safe treasury management.
That's right. So if you don't know, similar to like how Jupe, when they're doing their router, like that's actually an off-chain operation to like through the router, and then they're sending the transactions for you to sign. We have a similar deal where we're event tracking all lending protocols, like all their movements, to like calculate everything. And we have an off-chain program that's doing the algorithm work to figure out the best allocations if we should make a move. And then if there is a better allocation for us because rates have changed, it is sending that transaction to the program to execute, to like move that money to the right spot. And so there is this like balance between kind of off-chain operations and on-chain operations. And in the event of some exploit going on, there's certain conditions that we've kind of flagged that would say, "Ooh, this is going on. That's no good. It's like violating our configuration parameters. Get the money out of there. The utilization is way too high, or hey, this stablecoin has moved outside of our comfortable range. Like let's get out of those positions and like make sure that we can get liquid if we need to."
Gotcha. So during an intense, let's say rates just start going wild, how many times could money move in say 24 hours?
Yeah, great question. So we don't operate on like a consistent clock basis. It's not like, hey, every hour we wake up and look and do we move. We try to be a lot more intelligent about it than that. There's a few factors that go into this. So how fast could we move? Like we can move every other block if we wanted to. It could be super, super fast. Now, that makes zero sense because yield is like an over time thing. And if you move it too fast, you never accumulate any yield. And that would like handcuff ourselves. And we look at it and say, I think it's every 10 minutes, every 15 minutes, every 5 minutes, we're like doing event watching on chain and saying, hey, we're ingesting all this data and looking at rate changes. And saying, hey, like, here's an opportunity. There's like jitter involved. Like if a rate is just like 0.1% better, that doesn't mean we should move it. Again, it'll bring the rate down anyway. So we have to do these like future projections and stuff like that as well.
What's jitter?
Jitter, think of like how the USDC price kind of moves up and below 1 all the time, but it's like pretty micro movements. We call that this little jitter. Like the value is pretty much like the rate's pretty much 9.2%. But it's really like 9.22242. And so there's a process of figuring out, hey, is the rate good enough if we move the money to represent an opportunity for us to like move that money?
Gotcha. No, that makes sense. So we have a couple more like security questions. Maybe we can go over the audit.
Yeah.
But first, I think it'd be quite interesting. I've got a couple of questions. We've got something you're not going to be able to answer all these questions. So if you can't, you can say what you like. But this is a question for which a lot of people would be thinking: is it going to be a governance token? Will you have a token? What can you say? What can't you say?
Yeah, the reality is like we are a DeFi protocol. It doesn't make sense for us to not have a token. Now we are taking the viewpoint just from experience of our time in the industry, in the ecosystem of we want to make sure that one, the token would have value, and making sure we're offering a product that has value, that it needs to be governed. And so kind of moving slowly in that direction, and it'll be in line with as we move to decentralize the protocol. That's when that token is the right mechanic for us to do that. So we don't have anything in stone yet. In fact, if you were to tell me, will you have a token? I probably have to say no. But yeah, like we will move in that direction as it makes sense. And in particular, like the one that comes up a lot is like, what about points? So like we're obviously like earning Camino points right now, and margin 5 points if they ever turn into something of value. And that would be a way that we'd use governance to figure out, hey, what are we going to do with those? Do we want to use them as governance? Do we want to return them into yield into the pool, which is probably the most likely scenario? That would be something that turns into kind of a community management rather than us kind of making executive decisions.
Yeah, that's not the easiest decision to make, because if you have $1.2 million in Camino, I don't know what that works out to be in terms of yield, but it's probably like an extra 5 or more % per year.
Yeah. We have to figure out like how do you drip that in the right way. There's an exploit there. If someone can do kind of a sandwich attack of like buying a bunch, then the airdrop kind of happens in the pool and the token exceeds massively. Exactly. So there's a lot of thought and like being thoughtful about that that has to go into any of those decisions.
Yeah, of course. Now the other thing, of course, like all dApps need revenue. So this question, the Carrot team will gain any rewards or fee to do this management, like a BlackRock ETF? I guess I imagine you would have the plan of you want to reach a certain amount of TVL, certain number of users, and then you take a portion of as a management fee or something.
Yeah, that's exactly right. So it's written in a protocol fashion to where the CRT token is the first token we issued. We can issue more tokens if we want to. But in the protocol, we have the ability to take a performance fee, which happens through an inflation mechanic, where let's say we earn 18% over a period of time in a certain strategy, and we're like pulling that money out we can assess and say, hey, we earned 18%. That's great. We're going to take a 10% management fee of that 18%, which ends up making the real yield for the user somewhere around like 17.2%. Like it brings yours. So like the user is going to see 17%. Now we might achieve 18%. But the tokenomics like will show like, oh, okay, 17% is where it was. And like we've earned that kind of performance fee there. Now during this beta period, we're not taking that performance fee. Performance fee is 0 right now. And it's exactly like you mentioned. Before we try to extract revenue or like do anything like that, we got to figure out, does this work at scale? We're still like working and hardening the protocol and figuring out the edge cases of, okay, how do we do this right? How do we do rate compression? What about these cases? What if we do 100 redemptions and issuance at the same time? A lot of things that like we need to scale this thing. But that is part of the future plan. However, the reality is like, yeah, performance fee is great, but it's like, it's a pretty small pie. We think the real opportunity is probably developing a borrow aggregator as well. It's kind of the same set of issues you have. It's more complicated than that. But if we can also do the borrow lens in those pools, that's where the real spread is, that 20 basis point spread of where Camino and MarginFi are earning a ton of revenue on. We're not there yet, but we feel like it's a better way to go long-term for revenue rather than just focusing on a performance fee, which ends up being like a little harmful for users over time. So it's possible. It's not. We're probably a long ways out before we say that like that's the right move, to do. What we care about right now is making sure the protocol is hardened, it works at scale, and is really fast and does exactly what we say it can do.
Okay, that's interesting. So I want just to go over the audit shortly, just so people can understand how to read it and work out with their own research if it's trusted. But
yeah.
So basically, like, I mean, I don't know what you'd crunch the numbers, but even with $10 million making 18%, then you take a small cut of that. It's not a whole lot of not a whole lot of money. With $100 million, then it starts to be something to maybe keep a team going. But essentially, how would it work? Like, can you kind of paint the image of how it would work when you're talking about the borrow side? So are you saying like I would go and put in 500 Sol, and let's say that's worth $50,000, and then I want to borrow 25,000 US dollars, and then you'll do like flash loans and such, and you'll try and keep my loan as low as possible, and you'll take a little performance fee there. Is that the value? Have I got it right?
You probably shouldn't touch on it too much just because it's a super future thing and don't want to confuse people with it. But essentially, it's close to that, where as a borrower, you have the same problem that you do as a lender, where the rate fluctuates a lot on you. And if we're able to aggregate those rates, it puts us in a way where like we can benefit our token holders by playing an unfair game because we have access and the ability to move funds to the best rate possible, not just like the one that you choose. But yeah, I'm going to table that. That's certainly like a big feature.
That's far more work. Yeah. Gotcha.
Yeah, far more work for sure.
Great. Do you mind sharing your screen again, showing the audit, talking us through, the reputable company that audited, for a little bit more information for people that want to have a little bit of a risk analysis. In particular, with this question, what's the chance of your protocol getting exploited?
I mean, what's the chance? The same as everybody's chance of getting exploited. But if we talk about, hey, what are the risk vectors that are like most likely in there? Like what are exploits of other DeFi protocols? There are a few levels, and it's in our docs. We talk about, hey, what are the risks? There's our protocol risk, which is why we've been audited. In fact, our second audit was already underway to kind of make sure there's not any exploits in there. And when we talk about exploits in the DeFi protocol, it's actually more rare for it to be exploited through someone got access and just withdrew all the funds, like stole everything, like a robbery. It's actually more likely that there's some sort of exploit where, we didn't realize that we had this rounding error. And if you were to quickly do this action and this action, there's like a small delta to be made, which if you're exploiting it, then you like run a program to like do that 1,000,000 times over, and you like slowly drain the pool through this like mismatch of numbers. And that's like the most common thing that we were going through in our audits. of figuring out, hey, what are the vectors that somebody potentially could manipulate the protocol to extract value in a way that is not congruent with like how we expect it to be used, right? And so Sec3 is we think a top flight audit company. They were our first choice to go with when we were looking at, hey, who can do our first audit? They've done a lot of the Jitter audits, and so super familiar with DeFi. They've done other DeFi protocols similar to ours. It's kind of knew that they knew the space really well and kind of had seen and researched a lot of the potential exploits. And you can go read this on our site for sure. But probably like the main one that kind of changed how we do stuff is because we use pricing oracles and how we value, like our NAV price is done in USD. And so because we have those pricing oracles, there's a chance to say, okay, if you deposited USDC or USDT and there's an arbitrage there and you like quickly withdraw it for USDC, you're like getting essentially like a free swap out of it. And there's probably like an exploit there. And it's why like we have a 0.05% withdrawal fee, which actually isn't a fee for us. It's like, it doesn't go to our bank account or anything. It gets returned to the pool as yield for everybody. But that helps protect to make sure that a quick price arb there like doesn't represent an opportunity for somebody to just like cycle, a million transactions over an hour in order to like find, oh, I'm getting like half a cent every time. It doesn't sound like a big deal, but it can be if somebody is malicious enough to kind of go through.
Gotcha.
And run
so
something like that.
0.05% of a redemption fee. How long do you have to be actually earning, let's say 10%, for that to be to break even?
Yeah, get over that hump. It depends on what that rate is. 10%. We had calculated that it's about a little over 24-hour period. It's about a day. There's some other things that can happen, like if USDC like is above $1 when you deposit and it's like below $1, that can affect some of those things in there. But it's about that time period.
Gotcha.
Which, like, truly, if you are attempting to earn yield, like this is a long game. Like you should be thinking of these things in weeks and quarters, not necessarily like a few hours in that.
I understand that. Now I'm just going to put this up just because someone's internet cut out. Is it going to be governance token? You're not confirming or denying, but you understand that, dApps applications, they do need this to help, become more and more decentralized when the time is right.
Right.
You've acknowledged that there's no public information on a points program, but this is a competitive way to gain more users. Maybe there's something in the background. Regardless, either way, you've got on-chain data. You can always work it out if you decide to implement it. Is that, I don't want to put words in your mouth, but a fair statement?
It's a very, very, very fair statement, Seb. Right on.
Brilliant. Okay, well, look, I think we've gone through this pretty well. I think there's one last question here, and then if any further questions, all right, I'll give a summary, and then we'll go from there. Did you want to answer this one? Can you see this on your screen?
Yeah.
What
so things are early. So
yeah, being early.
People talk about the best time to start earning yield was yesterday, and the second best time is today. So like the earlier that you're in, certainly like accumulating that yield at a great rate. We track all this stuff, and so again, I'm not saying that we have an official points program, but the on-chain data is forever, and we know, and have some fun things planned, and just to like be super straightforward about it. Part of the reason of not wanting to like stake that up front or trying to juice things is mercenary capital just is overall bad for a protocol, of people just using it just because they're getting something extra. And if that is the case, and you're trying to like find that extra from somewhere, which then puts you at kind of a deficit of either taking on more risk or finding ways to kind of juice that for people, that ends up not being sustainable. And in this phase, we really want to hear the feedback and know like, hey, like, do you care? Do you like the product? Is it valuable to you without any sort of extra, oh, it's valuable to me just because you gave me something extra? We need to know and figure out quickly, is it valuable to you just because you like the idea of holding a token that is useful in DeFi, that earns yield at a highly competitive rate and has risk management built into it? Simple.
Cool. Brilliant. And actually, I have one more question myself, and that is, Look, to me personally, nothing's financial advice, but it's always worthwhile getting into something early. You know, even if there's never a points program, this I will sum up at the end, but you know, this has what I think is a very good risk portfolio. If that's maybe the right word, it's just a risk
Sure.
management system that's done very well. But the question I had is, so you've got USDC, USDT, PYUSD has a few more difficulties with claiming and whatnot, because they're getting extra yield right now, and that's coming soon. But what about any other tokens? Like, any plans for them? Who knows? Mum's
Yeah,
the
I
word.
mean, truly, like stablecoin growth on Solana, we see is rapidly growing, and we see there's a lot of value for having essentially like an index of stablecoins represented by one coin, which we think CRT will be that. And so we're always looking like adding more stablecoins to the mix that are kind of helping along of saying maybe you don't know which stablecoin you'd rather hold the yield bearing token version of a stablecoin rather than holding just your stablecoin of choice, right? Similar to how I think the ecosystem was really largely woken up to the idea of, oh, it's better for me to hold an LST than it is for me just to hold Sol. If I'm like just long-term holding it, it's better for me to stake it. And if I'm not going to stake it because I want it to be liquid, it's better for me to have a liquid staking token than to have just the token, 100%. And we think like as more and more consumer grade finance type transactions are going through, it's the same thing. You know, instead of holding stables, you might as well be earning yield on those stables. And instead of having to pick one protocol, you might as well just swap into a yield bearing token like CRT and get those benefits and earn the best yield across the whole ecosystem that way.
Brilliant. Okay, so at present, yeah, we don't have any information on if Sol's going to be added or whatever, but as you said,
Yeah,
there's
so
plenty of
we won't add Sol like to this token. If anything, again, we can issue a lot of these types of tokens if we want to.
Right.
So we could issue a Sol version. Like we could issue like something that's very similar to INF. You know, that is like a bundle and basket of all the LSTs that all go into that. Super possible for us to do that. We just want to be hyper focused on this first product because we know it represents the protocol at large and the success of it. And that one, it's part of its stated use case is not to add in speculation risk into that pool, which is why it's stablecoin. It's why it's straight borrow lend rather than looping or taking on any sort of lending or liquidation risk inside that pool.
Yeah, I understand. I understand the reasoning there. It's a safe approach, and I like that. The last question I have is, oh, actually, this is probably a good question.
Yeah,
but
I just saw this one. It's a good one. I'm gonna pull it up there. So liquidity is actually a great topic. So one, the token is fully collateralized. So there's always liquidity backing the token. It's where the value comes from. It's not a governance token. It's not airdrop. There's no fixed supply. So it's open-ended. And every token is represented by a hard asset that you can always redeem it to get it back. And the other side of it is like, okay, liquidity. And we launched some early LPs, pretty disappointed with the token 22 support on LP creation. It's actually horrible. And working with some partners to like kind of fix that.
You're working with Fluxbeam and whatnot?
Yeah, we've reached out and, we've talked to the Orca team, talked to the Medora team, Fluxbeam still permissionless, like we can go make that pool. But their fee structures are actually also pretty whack. Like we're charging that 0.05% redemption fee. The lowest fee that we can get on a pool right now for a token 22 is a 0.25% swap fee, which again, just makes our range of our price. Like if you go look at our chart, you'll see that it like jumps high, low, high, low, high, low. The true NAV price is actually pretty close to the EMA, the moving average price in it. But using a swap pool because of that fee just makes it a little hard. So we're about to start our bot operation and our market making just internally. It's like run that so that we can keep that token price in line. Because again, that's what the wallets use to show what the price of the token is. For better or worse, we kind of have to like deal with that system. But yes, like while you are holding the token, even if it's in the pool, like the token itself is the thing that's accruing value. So it actually doesn't matter if you put it in a pool, you technically still have ownership over it. And so you're always earning. It doesn't have to be staked in order to earn. It doesn't have to be like put away or taken off the market. Like there's no tricks or kind of these perverse incentives that we have to do to like pump the token price up at all. Like the token price is based on the yield. The yield is always happening no matter where you put your token, whether it's in an LP to earn extra yield on it, or holding in your wallet, it doesn't matter. Like it is always earning yield in the form of the CRT token. Now, the counterpoint to that is, let's say you had $100,000 and you're like, okay, should I do the LP thing or should I put it all in CRT? Well, currently, like we're getting between 9-10% APY right now on the token. And so you'd say, great, I want to do that instead of putting it half of it in CRT and half of it into an LP where you're getting 0.25% fee on the swap on a quarter of it. You know, so there's certainly like some of that, and so that's why we're taking some of those measures to kind of run some of those things on the external liquidity providing front, which I believe is really the question that you're getting at.
So really, providing liquidity is not really the best idea. Yeah,
it's a little altruistic. I'll be honest. Now, will you make money? Yes. You know, we only put, gosh, I think we put $10,000 in that liquidity to start out, just like we get a token price, and like this is how people verify tokens these days. So it's kind of you gotta do it no matter how legitimate you are. But yes, that spread, like you'll earn a fee and you'll still earn, you know, your yield will accrue on the token, on the CRT that's in the pool that you own, but it won't earn at the same rate for the USDC that's on the other side of that pair.
Yeah, which is common. It's you know, it's quite common to have like USDC and USDT, put them into a liquidity pool, earn less than if you just lend it out. So liquidity pools aren't really the alpha unless they're incentivized. Great.
Well, which maybe we could do. You know, we're not doing it yet, but you know, maybe that's part of the solution that we should consider.
Maybe. Actually, I wonder. We got one more question here. The team has around how many people? So you've got you and Jack, technical
me and Jack,
guru.
And then Alan is our head of partnerships. He is our third member of the team. And then the Skyrise team kind of feels like internal. We've got a team of 4 people from their team that are kind of embedded in our team, which has been great.
And they run like Twitter and Discord and...
Yeah, outreach, Discord. You know, our Discord's coming soon. People are, you know, we just have a Telegram chat right now. You know, didn't want to do a Discord and make that a distraction, right? If it's time, but it's time that the Discord will come soon. It's just a support channel and official messaging and stuff, a little bit easier than the Telegram.
Perfect. Well, thanks very much. I have one closing question, and that is, what do you think? What is your vision? Like, what do you think? How big do you want this to grow? How big do you think it will grow? Is there anything you want to publicly say? Sometimes people like to keep things really close to their chest. Other times they want to.
No, you got to share that. You got to share that vision. You need other people to get on board with it, right? The way I see it is crypto like helps democratize things that were only available to certain classes or wealth tiers before to everybody. And you know, access to certain financial vehicles, you know, things like that. And we look at in capital markets, you really want assets that are yield bearing to be earning yield up until the very moment like you need them to do something else, make a trade, pay for something, you know, all that. And in crypto, like through a yield bearing token like CRT, using it in a dollar cost average scenario, or using it you know, in a prediction market, or being in a pool or something like that, where it can earn yield up into the very moment that it's needed for a trade or for you to swap or to do anything, gives a level of, no matter how much money you have, like you can do this with $10, you can do this with $100, you can do it with $1 million, or billions, or whatever financial institution. Like this is how they work and operate. We see the prevalence of these yield-bearing tokens as being a way to offer that benefit for everybody. You know, think of your Venmo balance or your PayPal balance or wherever your Cash App, whatever you might use as in a non-crypto way. They're earning yield on your deposit. You're not earning any yield on that deposit. We think people should. We think you should earn the benefit. Like you're taking the risk on as a holder, even like USDC, right? This is a big complaint for people on USDC and USDT is they're earning yield on your stablecoin deposits essentially, and they don't share it with you at all. You take all the risk by being a holder, and they reap a lot of the benefits. Now, longer discussion, whatever, but our hope is for people to recognize and want to use either as the protocol or app that wants to transact in US dollar, to say, we might as well just hold CRT and then distribute it back in whatever they want. And in the meantime, like we make money on that spread. And for users to say, at every moment in crypto, my assets can be earning yield for me. They can be put to work. And we see a future where like that is super, super prevalent, where it's like the expectation, not like this insider feature that you got access to.
Brilliant. All right. Well, that's everyone's questions. I'm going to now sum this up in my best elevator pitch.
Oh, this is great. I can't wait.
Yeah. So what is Carrot DeFi? Carrot DeFi is essentially US dollars set up as an LST, a liquid staking token. It accrues yield. And as it's been stated, you can use this to buy more assets in a dollar cost average that you can set up with, say, Dupe, and it can just filter in, and that dollar cost average could go over a month, and you'll continue to earn yield in that US dollar form, and then you'll be buying a little bit more of a new asset in 2 weeks compared to now. And you're also a major thing that this has is the US dollars that spread amongst different protocols. They can respond faster than you can respond. They can move faster than you can move, which gives you better security, because if there's an exploit with one, you're safe with another. Although I do think, the things that you're using have a low chance of being exploited because they're trusted and audited and so on. But that's not the best elevator pitch, but it's a better understanding than what I had at the beginning.
Gosh, that was great. And even just to highlight that point you're talking about of, it's essentially we're giving the tokenized representation of active management for passive holders, like cold wallets, like treasuries, places that can't take active management positions can hold this token and get the benefits of it without having to do a darn thing. They just hold it. I love it.
Yeah, exactly. Well, the last question, I think it's just more of a funny thing, but will there be any other fruits or vegetables? I imagine not.
Yeah,
but if there would,
people ask about this.
Cool.
I get a lot of flack from some OG people of like, you're going back to the farm meta. You're going back to the 2020 days. And it all started with like carrot versus stick, like the incentives, like, hey, you can incentivize people by either hitting them with a stick and getting them to move in that direction, or you incentivize them by putting like a carrot in front of them. So carrot is our one and only vegetable. We are exclusive monogamous to the vegetable of a carrot. But who knows what the future holds?
Gotcha. Is carrot one of those things of like, is it a fruit or a vegetable? Is that one of them? Like an avocado?
No, straight up. No, straight up vegetable.
Okay. Great. All right. Thanks for your time, JSB. I'll have the links below for anyone that's want to follow. And if you do want to jump into this pool, you can use the referral code xmonty, XMONTY. I'm using it myself. And yeah, I wish you all the success. I hope your TVL grows. I hope the APY grows as this bull market continues. Yes. And I wish you success.
Great. Thank you, Seb. Always a pleasure, man. Good to talk.
Likewise. Thanks. We'll end the stream now.